So the gap between the deficit of silver is getting bigger and bigger every year. And the only way you can get that enough silver out for industrial use is to have a higher price, which will suck out the above ground supplies, i.e. people melting down their bars or selling their ETFs or handing in their coins, or the grannies taking their candlesticks along to the junkyard to be melted down. That's the only way you can get enough silver to balance the books. So I do think silver has to go higher, but also bear in mind it's not a one-way racetrack. We'll have times when some other assets are rising and silver's not rising or even falling. We'll have times when gold is rising. All these things they'll take their turns, but long term, I think everything looks like it should go higher.
The COMEX gold futures market is undergoing a quiet but fundamental shift. What was once a venue for paper contracts and rollover trades is now moving large volumes of physical metal, something it was never really built to handle. Between 2023 and 2024, deliveries have surged well beyond historical norms. Clive Thompson, a retired wealth manager tracking the data, says the activity is off the charts. Every month this year, except June, has seen delivery volumes several times higher than average. Earlier in the year, fears around U.S. tariffs triggered a rush of gold into New York warehouses. When the Trump administration introduced a carve-out for precious metals, that inflow paused, but now the metal's moving again. Registered gold on COMEX has rebounded to a 2-month high of 38.7 million ounces, reversing the Q2 drawdowns that had led many to write off physical demand. Speculative activity from Chinese trading desks and fresh institutional buying are helping drive the reversal. Here's where it gets interesting. No one knows exactly who's taking all this metal. Thompson suspects it could be hedge funds, possibly Berkshire Hathaway, or a foreign government quietly rotating out of treasuries. It's likely not China, since they usually source gold from London, not New York. What we do know is that arbitrage is at play. Traders are buying spot gold at lower prices, delivering it to the COMEX, and settling short futures to lock in a risk-free profit. It's mechanical, but the preference for physical over paper is becoming harder to ignore. At the same time, China is operating on a completely different level. Gold demand there has exploded. Warehouses tied to the Shanghai Futures Exchange are now flooded. Over 36 tons of gold bars have been registered for delivery, twice the amount from just a month earlier. It's the same story, different geography. Real metal, not contracts, is what buyers want. Thompson doesn't hedge his view. Someone with serious capital sees stress ahead, and they're not betting on paper claims to protect them. They're going for physical gold, and if that mindset spreads, the pricing structure of the gold market, and possibly its function, could shift for good. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, the first thing I notice with respect to gold is that the COMEX deliveries of 100-ounce bars of gold is continuing at a far faster pace than a year ago. And that's been every month this year. So in January, it was more than 3 times the usual number of deliveries. February was 3.6, March was 3.2 times the normal, April 3.5 times, May was 9.5 times. I think that was to do with the worries about the tariffs. Then there was a slight settling in June where it was the same as last year. And July's number was over 3 times again. So someone somewhere is deciding to take delivery of these large 100-ounce bars. That's like $350,000 nearly each.
Wow.
We don't know who it is, but it's obviously a very, very unusual situation that the number of people demanding delivery of their gold bars is way above normal. And because COMEX is normally a futures market, people, you've got 2 sides to it. You've got the shorts and the longs. So the longs will typically buy a futures contract, let's say in July or August. And when it reaches maturity, they'll sell the futures and then roll it forward to another maturity date, 6 months or 3 months forward. Whereas on the other hand, the shorts, they normally have the metal and they'll sell it forward, collecting a premium. So they'll sell it forward at a higher price. And when it reaches maturity, they'll buy it back and roll it again for 3 months or 4 months, collecting a premium. They make money from the difference between the 2 prices. But what's actually happening is those people who are at the long end of it are actually not rolling their contracts. They're saying, I'll have my gold, please deliver it. Where it's going, nobody has come up with an answer. We don't know if it's the government itself. We don't know if it's Berkshire Hathaway. We don't know if it's the government of Canada or Mexico or who. Someone is taking delivery of those bars. Maybe it's a big hedge fund, but clearly there's something going on that someone knows or thinks they know something, and the deliveries are absolutely mammoth out of COMEX into physical metal, which is being removed from COMEX. First of all, I think if it's China, they would probably be taking delivery out of London. That kind of would make more sense. So I'm guessing it's not specifically China, though one can't say they're not buying elsewhere. My best guess is that it's a combination. I don't think it's the government, unless they're trying to refill the vaults, which some people say are empty. Well, we don't know, but it could be that. It might be Berkshire Hathaway, who've been sitting on this mammoth cash pile of 3 point something billion dollars for, is it billion or trillion? I can't remember. Billions, I think, for a long time, and they don't know what to, is it. There's three. I've got the figure now, but it's anyway some mammoth balance.
Right.
Whether they are going for gold or not, I don't know. Obviously, Warren Buffett has never been a fan of gold, but he's retired now. But his dad was a great fan of gold, and he grew up in a household full of which were bullish of gold. We know that Warren Buffett himself is a fan of silver. If we go back in time with all his silver purchases, not only for himself but also for Berkshire Hathaway 20 years ago. So it could be that Berkshire Hathaway are acquiring gold on the sly because they've got to do something with their cash, and they kind of missed the boat with all that cash not being in the equity market, which has just gone roaring ahead. On the other hand, it could be one of the neighboring countries like Mexico or Canada deciding to top up their reserves with gold, replacing it with getting rid of the US dollar treasury bonds. It's quite hard to say, but someone out there is doing it. And if I had to have a best guess at it, I'll just say it's a collection of large hedge funds who see which way the wind is blowing. They can see that something's about to happen, and they just want to be prepared for it. So my message is get out now and start buying things which will hold their value. And it doesn't matter whether you think it's bottles of rare whiskey or silver or gold or equities or Bitcoin. I mean, perhaps everything you lay your hands on, I would say. But obviously, I do. I am a bit of a fan of silver because I can see that the supply and demand situation is very much in favor of the silver price going higher, because the mined supply 3 or 4 years back was started to be below the industrial usage, mainly electronics. So that industrial usage is still rising rapidly, but the mine supplies of silver coming out of the ground is not rising. It's not rising at all. It's going down. So the gap between the deficit of silver is getting bigger and bigger every year. And the only way you can get that enough silver out for industrial use is to have a higher price, which will suck out the above ground supplies, i.e. people melting down their bars or selling their ETFs or handing in their coins, or the grannies taking their candlesticks along to the junkyard to be melted down. That's the only way you can get enough silver to balance the books. So I do think silver has to go higher, but also bear in mind it's not a one-way racetrack. We'll have times when some other assets are rising and silver's not rising or even falling. We'll have times when gold is rising. All these things will be, they'll take their turns. But long term, I think everything looks like it should go higher. Will it be the best asset and best outperformer? I don't know. I mean, I just think it's one which you've got to hold as part of your portfolio.
Clive Thompson is even more bullish on silver than gold, and he's not the only one. The core issue is straightforward. Demand is accelerating, but supply isn't keeping up. Silver has outgrown its role as just a monetary metal. It's now a critical industrial input, and we're burning through it fast. Last year, global industrial silver consumption hit a record 680 million ounces. That record won't stand for long. Projections for 2025 already indicate 700 million ounces, with over 80 million ounces destined for the solar industry alone. These aren't theoretical numbers. They're grounded in real-world infrastructure, energy policy, and manufacturing trends. Meanwhile, supply is heading the wrong way. Since 2016, mine output has been declining at an average annual rate of 7%. Recycling is up, but not nearly enough to close the gap. And in most of its industrial uses, silver can't be replaced. This imbalance leaves the market with only one path forward: price. For industrial users to secure the silver they need, the metal will have to be pulled from private investors. That only happens at higher prices. Until then, the supply squeeze deepens. Thompson isn't calling for silver to explode overnight. He knows markets don't move in straight lines, but the direction is clear. The fundamentals point to a sustained move higher, and ignoring that setup means missing a key piece of the larger economic picture. Let's get back to the interview.
First of all, we're seeing these vitriolic attacks from President Trump on Chairman Powell. I think he called him a moron the other day. Now, obviously, that would be a criminal offense here in Switzerland or Germany or somewhere like that. You've got freedom of speech in America, so it's not quite so serious. But let's just say Powell must feel under a lot of pressure. We've had in the last week 2 members of the FOMC who've shown dissent, the first time in something like 30 or 40 years that there's been dissent in the board, because they've come out publicly, I think on Fridays, explaining why they dissented on the interest rate decision. They wanted lower rates. And then we've also had in the last few days one of the other members of the Federal Reserve Board tendering her resignation 5 months before her term was up. So it kind of feels like there's some sort of dissent brewing at the Federal Reserve at the moment. So I think that Powell will be under pressure, along with the rest of the board, to do something. And we've seen the possibility of a Fed cut in September go from 40% probability before they had the FOMC meeting until after all these latest movements happened to a 94% probability. That's on the CME web Fed Watch. You can look that up yourself and see. But so we're obviously getting to a situation where the market now thinks there's a dead cert almost of an interest rate cut in September. And then, of course, the market is predicting 2 cuts this year. That's again from the CME Fed Watch. So I think interest rates probably will cut. Usually they get these things right. I think the other thing which is maybe of interest is we had the employment numbers last, I think it was Friday, and they were terrible. They came in at less than 100,000 expected. I think it was 78,000 or something like that came out. But they only got to a positive number because they revised the previous 2 months down by something like 250,000 jobs. If they hadn't revised the month down, this month's number would have been seriously in negative territory, which shows that the employment market is in serious trouble. And one's got to wonder why the Federal Reserve and Chairman Powell didn't know that. Are they just totally relying on the Bureau of Labor Statistics numbers and nothing else? Or do they not have their own sources? But they kind of been out of touch with reality here. And I think that realization must have set in the last few days when those employment numbers came out. And I think, the cut in interest rates is almost a dead cert. The financial system, in terms of the money that you're using on a day-to-day basis, is not going to be the same. And I would say probably sometime in the next 10 years. So if you happen to be a holder of cash or bonds, and that's not just government bonds or bonds of any description, you might find that you are actually holding a currency which is going to become effectively defunct. Whether that happens through rapidly rising inflation or whether it happens due to the replacement of the currency by, let's say, central bank digital currency, CBDC, or stable coins, and then they suddenly say all transactions have to be in this new currency, central bank digital currency or stable coin or whatever it is, and then they say, well, sorry, you can't convert your old money to the new one, or you're only going to convert 10,000 or 100,000. I think something's got to happen to take the pressure off the government debt, because the government's debt is rising faster and faster. And the problem is, over the next few years, we have 9 trillion of debt. Over the next 4 years, 9 trillion of debt, which is going to mature, most of which was taken out of interest rates of 1.5% to 2%.
Right.
Interest rates on government bonds now are 4.5% or 4.2 to nearly 5%. So all of that's going to be renewed at higher rates, which means that the interest rate burden as a percentage of what the government is taking in taxes is going to rise rapidly. Already in 3 years, we've seen it go from 8% of the tax take, that's the interest rate burden, to 18% of the tax take. And that figure can only rise for two reasons. One, because the debt is rising faster than the GDP is rising, therefore rising faster than tax intake is rising. And secondly, because of all this debt, which is going to mature and has to be renewed at a much higher rate. So the problem is it's unsustainable. And Chairman Powell has said it, Janet Yellen has said it, the head of the Congressional Budget Office, whose job it is to know which way the wind blows, has said it. So we've got a lot of people who know what they're talking about saying this is unsustainable, it can't last, and I can tell you it's not going to last, so something will have to happen. And obviously the things which perhaps the dreamers hope for is higher taxes. Obviously, nobody hopes for higher taxes on themselves, but perhaps higher. If you happen to be the government of Japan or the UK and you're holding US treasuries, you're hoping for higher taxes or lower expenditure to balance the books a bit. But these things are not really going to happen. So something else has to happen. And, there's a lot of possibilities out there, but none of them are actually good for the holders of fiat currency. So what's my first bit of advice for young people who are saving? That is, unless you have a need to keep cash because you've got a near-term need, like buying a house or something, you want to be saving in other types of assets. These are assets which will be here if the currency which you use on a day-to-day basis starts to fail. So right. It's no harm in having enough to spend for next week, next month, and some emergency money. But beyond that, saving in fiat currency, you're on a hiding to nothing, because at some point it's going to go very, very fast in the wrong direction. And if you want to change it into something which is worth saving, you'll be trying to do that at the same time as everybody else is trying to do it. On LinkedIn today, I wrote an article about what happens when a president tries to control the central bank. And I used as an illustration the Erdogan's control of the Turkish central bank, which resulted in extremely high inflation. Right. And a 80% devaluation of the currency when he tried to, he basically fired the central bank governor for raising interest rates. Now, I see some similarities in the United States. I mean, we've just seen, for example, President Trump has fired Erica I can't say her name, McEntaffer, who is the head of the US Bureau of Labor Statistics. Why? Because she reported poor labor numbers. She's just the messenger. She's got a whole army of people gathering the statistics behind her. Trump's excuse was that she was manipulating the numbers for, to damage him politically. Well, if that were true, if that allegation were true, and I'm sure it's not true, but if it were true, then he should fire the whole department, because it can't be just her. It must be a complete conspiracy. But basically, that was his message. So I wrote an article not about that, but about what happens when a president tries to take control, and what you get is, at the end of the day, is a potential loss of confidence that the political pressures are being applied to your central bank, which does mean that you don't have, or you have less of a sound money policy, which is bad for the currency, good for gold, good for silver.
Something unusual is unfolding beneath the surface of the metals market. Gold is no longer just hedged or traded. It's being pulled out in bulk, transferred across borders, and withdrawn from systems built for paper claims, not real bars. Silver, once a side character in monetary debates, is now a centerpiece of global manufacturing and energy policy. Both metals are flashing the same signal. Faith in fiat systems is wearing thin, and critical materials are being locked down before the rules of the game shift again. If this quiet stockpiling accelerates, do we reach a point where the pricing power of futures markets starts to slip and physical supply starts to dictate the terms? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.